Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching a very special episode of Easynomics Today. We do a deep dive into India's economic future basis exclusive insights from a recent UBS report. Joining us is Tanvee Gupta Jain, the Chief India Economist at UBS Securities India. And the focus of that report, as I welcome Tanvee, is about India setting its sights on becoming the world's third largest economy. And that leads to a lot of crucial questions, including what happens to inflation, job creation, our fiscal policies, interest rates, and all of that. Tanvee, welcome. This is a wonderful report, and you have raised 5 key questions. What I really want to do on the show today is to toss each of them to you and get you to expand that and make it easy for our viewers. The first one is the curious case, as you call it, of India's K-shaped consumption pattern. Now, this was something that was debated outside of economic conversations post-COVID. So, take us through what is this all about?
Thanks, Siddharth. So let's start with India's consumption story. So if you realize since the pandemic, we have been seeing this K-shaped consumption pattern. This is not to say that India was a very equal society. We always had that gap between the haves and the have-not, but that gap kind of have widened post the pandemic. So what we realize is that anything which was mass market, entry level demand segments, they were not doing that well. But anything which was premium, affluent, luxury, the demand for that consumption items was very strong. Some simple things like booking a trip online, going and staying in a 5-star hotel, traveling by flight, buying a premium residential housing, buying a smartphone which is more than $200. So we were clearly seeing that even your luxury cars, where the demand so far was still holding up, whereas your aggregate passenger car sales have been muted. So what we realize is that dichotomy, it looks like could narrow or has already begun to narrow in FY25. So if I look at now what is happening on the premium or the affluent segment of the consumption, it is clearly showing signs of a fatigue. Why it is showing signs of a fatigue? Because the income levels, and we looked at the listed companies, corporate wages or employee expense, because we don't have a good metric for urban wages in India. And that is showing me that the urban wage growth, which was almost in double digit of 12 to 14% post the pandemic, is now gone back to single digit levels. It is still higher in single digit, but it has definitely moderated. Second is the household debt service obligations have gone up. We have seen pre and post pandemic that the credit growth in the economy has moved higher from 6% to almost as high as 18% at the peak. Only now it has slowed again to around 14.5% if I adjust it for the HDFC merger impact. And clearly, a lot of household leveraged up, whether they bought a property or they, took unsecured personal loans, and now the debt service obligations are going up for the higher income segment. And lastly, our estimates are showing a very interesting trend that the household savings could have marginally picked up in FY25, which was actually on a dis-saving trend, especially post the pandemic, because household accumulated savings and they were willing to spend. But now, if I look at the low income segment consumption, there are 3 things where we are expecting a pickup. One is the hope is that the rural demand will pick up because this year the monsoons were very good. The crop sowing progressed well. The summer crop harvest should come into the market from November onwards. Even the hope is that the winter crop sowing could be very good because the moisture content is very high and the water level in reservoirs is reasonable. Second is public capex. So far, the government capex was supportive, and we do realize that construction outside of agriculture is the largest generator of jobs. But now I think there is a concern because we have seen FITD, both central government and state government capex actually falling by on year on year. And lastly, I think if you look at the data, you will realize that there is definitely an increase in social welfare spending and stimulus by various states which have gone for elections or are going for elections over the past 1 year. And that is again the transfer of income going to the low end of the population. So in that sense, consumption, which has been growing at 4% year on year last year, we are expecting a recovery towards closer to 6% this year. But
Okay.
if I look at pre-pandemic average, it was around 6.5, 7. So we are still not going back to the trend growth what we saw before the pandemic. So let me stop here.
Tanvee, very, very interesting point that you have made, and I haven't seen such detailed analysis in the recent past on this subject. Quick couple of follow-ups. One, what would this narrowing of the gap mean at some point in the future beyond FY25? Do you sort of see this move further and the gap further narrow? Is that what you are likely to postulate?
So at this point, I would say the gap is narrowing in FY25. We do expect that gap to kind of stabilize in FY26. So if I look at my consumption growth estimates, consumption was growing at 4% in FY24, which we are estimating to grow towards 6% in FY25-26. So gap is kind of narrowed and kind of remains stabilizing. But the thing is, we need to realize that the rural economic recovery is still a lot more cyclical. How the monsoons are going to pan out next year, whether the government will continue to increase the capex spending, whether India will actually see the private corporate capex cycle recovering, which we are yet to see on a
do your mental maths on this, but remember 10,000 as the cutoff. What are the likely implications when it comes to our producers? For example, and you alluded to the real estate segment. Last 3 years, we have just seen super premium luxury housing flying off the shelf. You hardly get to see any affluent or affordable housing projects being launched. Is this likely to impact corporate spending and investment patterns as well?
Okay, so let's go in one more detail. So if I look at Indian household income pyramid and I divide the population into low income, middle income, and upper income, I realize when I look at the data that there are roughly around 40 million people with a per capita income of more than $10,000, when in India, the average per capita income is $2,500. And while our population is growing at 1.4%, people in the affluent segment, that is people with the per capita income of more than $10,000 are actually doubling. They are the fastest growing segment in India's population basket. So clearly, if I'm looking at more from a 3 to 5 year point of view, the segment in India from a consumer or from a corporate point of view, which should do well, is definitely the affluent premium segment. Now, there always are cycles, right now I'm seeing signs of a fatigue, but do I see from a medium term that segment not doing well? Not really, because that segment will see one of the fastest growth in the number of people going into that category. Now, coming back on the corporate capex, and we looked at the data on 4,500 companies in India, and we realized that there is a recovery post-pandemic, but that recovery has not been broad-based. It was concentrated in a narrow part of corporate India. And I think the reason is that the capitalization levels in India are still stuck at 75%. You need capitalization levels to go to towards 80, 81% for companies to start and begin expanding capacity. So while we are talking about the residential housing sector, I think that has done well. If I look at the housing sales for the top 8 cities in India, they're actually being quite robust. Stamp duty collection data, which is a proxy, is still doing pretty well. But yes, it is still concentrated in a narrow part of corporate India or a narrow part of Indian income pyramid and not really something which is more broad-based.
One more follow-up on this. Over the last several months, or actually almost over a year ago, we saw long waiting lists for premium cars. Equally, we have now seen a situation where that has changed, but a lot of inventory pile-up is happening, and that's also happening at the lower end, for example, in the two-wheeler segment as well. Should we look at that data from the perspective of this fatigue, as you call it, that is setting in, or is that a different phenomenon?
Absolutely. So So when I'm saying there's a fatigue settling in for the upper income household consumption, your luxury cars or premium variants of those cars are clearly showing a decelerating trend. So when you look at the data since 2022 and whatever data we have available so far, you realize that despite passenger car sales not doing so well, I mean aggregate number, and especially the one which is more basic model, a more entry level model, even in those time, your luxury premium segment car was still growing. I mean, they were doing pretty well. And now clearly there is a sign of fatigue because we are seeing that even the luxury premium segment is now showing a deceleration. But the lower end segment is yet to show a significant turnaround. I mean, I looked at the retail passenger car sales, the two-wheeler sales, and the September quarter was weak. Yes, there was a majority of 16-day sharp period which fell in September. Last time is in October. The hope is that the upcoming festive season spend might pick up, but with the way inventories line up, it looks unlikely that you are going to see a very sharp, quick recovery in the consumption segment anytime soon.
Okay. Uh, Viewers, one last point on this, and this is very, very important. Tanvee has written in the report that India will become the world's third largest economy in 2027, but could grow into the third largest consumer market even earlier in 2026. So that's a pretty fast clip. I wonder if you have any further comments on this before I move on to the next issue, Tanvee.
Absolutely. So if you look at in data and you realize today India is the fifth largest economy in the world in terms of consumption. But if I look at the last 1 decade consumption growth, whether in local currency or in dollar currency, the average growth which India has seen in household consumption expenditure is 7.2. It's faster than China, it's faster than US, it's faster than Japan, Germany. And the way Indian economy is growing, we do see that India will become the third largest economy in 2026, much faster than the way our GDP growth will shape up, or India will become the third largest growth market much later by 2027. But in consumption, we are way ahead. And I think partly it also has to be done because the consumption share in GDP is already very high. India is
Yes.
a consumption driven economy, unlike China, where we say China needs to consume more, India needs to invest more. So a part of it is also related to the way Indian consumption historically has panned out.
Uh, since Tanvee spoke about China, viewers, before I move on to the next question, I just want to bring out a fact that look at what is happening to luxury sales in China. They have fallen on the cliff. Very large companies have lost billions of dollars of market cap with Chinese luxury consumption going down. Tanvee, since we've spoken about the third largest economy possibility, you've also written that India's economy has been in a goldilocks phase since FY22 with stable macros and strong growth. What are the risks to this, including China, and what it might mean for the rest of the world and for our producers as well?
I think when you look at the way we are highlighting that we have been in a Goldilocks space, but now at least a lead indicator is showing signs of softening. We have something known as a composite economic indicator, which is a compilation of 15 high frequency data on India. And for the first time, for the month of September, it contracted. We did see a slowdown in the month of August. In September, it contracted, which a trend we have not seen in a long time. So clearly, the growth momentum, which was in a Goldilocks scenario, what we call for India, with strong growth, very manageable global risk, I think there is clearly the momentum has begun to slow. Now, what are the big risks? At this point, I would say the risk to India's growth are definitely tilted on the downside, and they are much more external risk than the domestic risk. It's not to say that there are no domestic risk. Yes, greater than expected slowdown in bank credit is definitely a risk that can bring down the growth, or if oil prices because of geopolitical tensions again go up significantly, that's a downside risk to growth. But let me touch upon something more interesting. One is where we are on the external risk. I think one big near-term event that we will be watching out very closely is the US election outcome. There is a risk of a potential tariff hike on China. In case Trump comes to power, what if there is a 60% tariff hike on China? And the view is that if China has some kind of tariffs and which is impacting its export, what if China's excess capacity starts getting offloaded in Asia, and why not India? So a corporate in India might prefer to buy a cheaper import from China rather than expanding domestic capacity that can further delay the private corporate capex recovery in India. So that is one near-term risk or an event risk that we will be watching out for. What happens on the US election outcome? Second is, so far, if you look at the global economy, I mean, global growth has started to fade. We have this global nowcast model, and it is suggesting that the growth globally is running at 2.5% in July. It was 3% by March. And what we realize is that right now it is mostly about Eurozone and China, but we still, US is holding up. But in case we do see soft landing concerns in US and there is a slowdown in global growth, we think India is not immune. So the best part is that India has one of the lowest beta in Asia to a slower global economy, but we are still not immune. We will still get impacted if the global economic growth slows down.
How much of a risk are you factoring into a significant change in US tariff and trade policies post a Trump return this November?
So I would say there could easily be 30 to 50 basis point downside to my numbers for FY26 GDP growth, because whenever the Trump taxes, even if they get imposed, we are not expecting to happen anytime before second half of 2025. And he's also talking about a 10% tariff on rest of the world, which could be even, more a 2026 story. So I think there will be more downside to my FY26 number of at least 30 to 50 basis point from here.
There's another very interesting point that you make, and this goes back to where we started our conversation. This is the shifting composition of household savings and the impact on bank deposit growth. I want to link that to the possibilities of a domestic rate cut, because traditionally Indian savers preferred the fixed deposit way, but there's now a Gen Z impact playing out when it comes to retail participation in the markets, Tanvee.
Absolutely. And I think it is something which is definitely a trend we are seeing since the pandemic. So if you look at couple of things. One, the household borrowings have risen. I mean, easier access to retail loans, digitalization, younger population, and plus the composition of household savings. As you rightly mentioned, that Indian household typically 10 years back used to park half of their savings or financial saving in a fixed deposit. Now they are preferring other asset classes, whether it's a property, whether it's an equity, whether it's a provident and pension fund, small savings. And clearly, when you look at the returns, you will realize that they have offered at least till FY24 a much higher return versus the return the household would have got, say, buying or putting their money in a fixed deposit. And other thing which I think the government also has been kind of cautioning is that the tax arbitrage and regulation definitely favors some asset classes more than others. So that is also one of the reason, why we have seen that trend. So why the question is how does it, or at some point will start impacting the rate cut scenario for India? So what we have to realize is that if a household is not getting direct household savings, he will rely on non-fixed deposit uh, pool of resources to fund the credit, because credit growth is still growing faster than your nominal GDP. In fact, if I look at the share of wholesale deposits that have clearly gone up over the recent years. Second is the government has also moved into just-in-time mechanism for their payment mechanism, so which just to bring in more efficiency to the cash management policy of the government, which has actually reduced the float available to the banks. Thankfully, the banking sector liquidity has moved into surplus, but that was a bigger challenge earlier this year. And the third is that you realize that almost 25% of India's market borrowings are being funded through small savings scheme, which is again a leakage from the banking system because that savings are parked with the RBI. So it is actually, not a part of the banking system. So we would say that even though my view is that there will be a 75 basis point easing in this cycle, the question is whether it starts in December or March. The challenge for banks is going to be an asymmetric monetary transmission. So it will be very difficult for the banks to cut their deposits in lieu of, or cut their deposit rates in lieu of the cut in the policy easing cycle
Yes.
because the gap between the credit and deposit continues to remain high.
Well, in some ways, good news for savers, especially those who are living on savings income post retirement as well. As we wind down this conversation, I want to get in one other point into the mix, and this is your comments about what is happening in the search for political gold. Many states and all the schemes that are being announced and the impact on the fiscal. Decode it for us. On one hand, it may spur consumption, but in the longer run, it could all be a train wreck. Tanvee, is that the right way to look at it?
I would partially agree to what you are saying. I mean, whenever we look at the government finances, everyone only looks at the union budget and, okay, wow, the central government is sticking to the fiscal consolidation roadmap and they might perform even better than what they have budgeted. But where I think the worry seems to be is the recent fiscal profligacy, especially in the poll-bound states. If you look at, there are 10 to 11 states that have gone for elections over the last 1 year, and we did see an increase in the stimulus spending by these states. So if I look at the fiscal deficit numbers, I realize that versus the estimates they provided in somewhere around Jan Feb, when states started releasing their numbers for the for the full year budget estimates, and they have actually modified that fiscal deficit in June, July. So the fiscal deficit versus last year is actually going up from 2.9 to 3.1% of GDP. And this is definitely going to weigh on states' own capex spending. It's already down 7% FITD. And we need to realize that it's a capex which actually creates jobs, where the multiplier impact on the economy is a lot higher than the consumption spending via stimulus or by populism, which we are seeing in the states right now.
Tanvi, when I have spoken in the past on this issue with government people, both at the state and center level, one comment has stuck with me, which is while money is given out as a handout, the other hand of the government receives some bit of it back through taxes of various kinds. When you discount all of that, given the needs, the social needs of a vast country with so many underprivileged in this country, you think there is no other alternative for the center and states to continue to run sizable welfare budgets?
So the best way to actually be more social welfare oriented, not from only looking at something from a near term, but also looking at something from the medium term, is to boost capex spending. Construction is the largest generator of jobs, and when you're giving them employment opportunities, that is something which is much more sustainable. Getting a cash handout, go and spend that money, the government is saying, okay, I might be getting some bit of it back, but that is not really the way I would be saying that what is the optimal use of that government spending. I mean, if you look at the GST collections, I mean, for the basic foods and the basic categories, GST rate is effectively zero. And only for the higher end consumption items that the GST rate keeps on going up. So again, anything which is mass market entry level stimulus led consumption is not something which is giving back to the government in terms of higher taxes, but it might be creating more macro stability risk, including inflation, higher fiscal deficit, which may not be sustainable in the long run. So I think that's why we always say that the quality of government spending matters much more than the overall quantum of government spending. So the multiplier for capex spending for every 1 rupee spent is a lot higher than the same multiplier for that 1 rupee being spent on a populist scheme to the lower end of the population.
Viewers, as I thank Tanvee for her time with us today, I just want to add one small bit from my side. Perhaps this question, the fifth part of her report, will get settled if and at all India moves to one India and one election. So at least we won't have this non-stop string of poll SOPs that keep getting announced and keep impacting state budgets and the overall macroeconomic stability. But for that, we'll have to wait perhaps for a bit more time. But Tanvee, I know you have a tight schedule. I look forward to speaking with you again on some other equally insightful report that you put out. Thanks very much for joining us today.
Thank you.
With that, it's a wrap on this episode of Easynomics. We'll be back with more. Do stay tuned in and subscribe. See you on the other side. Bye-bye.
It's now further slipping lower, almost a 3% dip on the Nifty Auto Index alone. Bajaj Auto is now down over 9%, TVS down over 5%, Hero Moto down about 5%, Eicher down 3%, M&M down 2.5%, Maruti down 2%, and all the other stocks are also now trending down, be it the frontline auto majors or even some of the major auto ancillary pack stocks as well. Of course, there is this muted festive demand that is probably one of the